Good morning. Hello. Welcome to the macro snapshot. We are Wednesday, September the 17th, 2025, recording this in the morning. Let's focus on the FOMC meeting today. So let's do a kind of a preview of that and just look at what's priced in and what the market is expecting and what could be some potential outcomes. Okay, so those of you who watch this video will more or less know this, but let's just see what's priced in. Today, the market is fully discounting a cut. So 26 basis points is priced in. So if they cut, that is fully priced in. Really, it's going to be about is the press conference, the tone, how many more cuts? Are we going to have 2 or 3 cuts this year? Dissenters and the forward guidance. So there's a lot of other stuff, but basically in terms of today, what is expected is 1 cut. So first of all, we have to say what would be a shock and a surprise would be a hold. That would be an absolute shock and surprise if they weren't to cut. And secondly, 50 basis points is not priced in at all. We only have 26 basis points. So a 50 basis point jumbo cut would be a major, a massive surprise. And secondly, absolutely nothing at all priced in for a hike. Now, obviously they're not going to hike, but hey, who knows, maybe Lisa Cook, who is now back on the committee, at least for this meeting, will show some vindictiveness, but I doubt it. So anyway, so what we have priced in is one cut. But what's interesting is, and then if we go out to the end of the year, we have by December, we have 2.7 cuts. So not 2 and not 3. So that's about 70 basis points of cuts priced in. So not 75 and not 50. So we're between 2 and 3 cuts by the end of the year. And if you actually look at the terminal rate, if we go out to 2026, so the market also wants to get a sense of, how much will it be cutting by? We get down to almost 6 cuts. So the maximum the market is priced in is basically by the end of 2026. You see here we've got 6 cuts. Does it go any more? I don't think so. No. So that's kind of it. So 6 cuts. So around about 151.5%, 150 basis points is what the market is expecting in terms of cuts over the next, sort of 18 months. So basically 2 to 3 next year, and then 3 to 4 in 2026. And we can see that here, if we look at the terminal rate here, you can see here, this is for the SOFR futures. You can see the market is expecting this cutting cycle. Each dot represents, of course, 3 months, all the way out, cutting down in 2026 until the end of 2026, beginning of 2027. We get to that terminal rate, which is about 6 cuts away, so 1.5% lower of the Fed funds rate. So we're getting something down towards about 2.8% or so. Keep in mind that the effective Fed funds rate now is about 4.3, so it's at 4.33. So down at 2.8 here, approximately, that's about 150 basis points or 6 cuts. So that's what's priced in. That's what the market's expecting. But what's kind of interesting to note, and I guess most people know this, but it's just interesting to look at it, is that the market at this point, at least for 2025, is more dovish than the Fed. So what we have here, we have the dots median is this green. So here's the dot plot. So this is the members of the Federal Open Market Committee, the FOMC. You see these yellow dots here. And you can see that that's gradually moving down as we go into we have end of 25, end of 2026, 27, and the longer term. So a gradual downward path. But if we actually then look at if we look at the median, you can see here, this is the green line, which also is down sloping. So far we go, okay, the Fed themselves are projecting that they will cut. But what's interesting, if you actually look at the Fed funds futures pricing, so this is the market's expectation and market's pricing, it's the white kind of bar here. And what we can see is that is below the Fed. Well, the Fed's summary of economic projections from the last one, which we had a couple of meetings ago back in June. So you can see here that the median dot is at 3.875. So that's effectively a Fed funds rate between 3.75 and 4. Okay, so 3.75 and 4. And at the moment, we are at 4.25 to 4.5. So that's two cuts. So all that to say that what the Fed was saying last time at their last meeting, where they had a summary of economic projections, was 2 cuts, and the market is pricing now almost 3, not quite 3, but almost 3. And it's the same situation here for 2026. You can see that the Fed's dot plot was at 3.6 percent estimated to be there, and the Fed the market is at 2.8, so about an 80 basis point differential there. So you can see here that is well below. And if we actually look here at a couple of things. I just made a quick chart this morning, and what I've done here, I've looked at basically the pricing for December. So this is the Fed funds futures for December of 2025. And what I've got here is the differential with the dot plot, which is at 3.875 here. So you can see here, this is the differential, and you can see here that we're below. It's not exactly the same because I'm using Fed fund futures. It's not exactly what shows on the Bloomberg there, but it gives you the sense that basically before those big revisions for in the August payrolls, that the market was a little bit more hawkish than the Fed's dot plot above. You see about 12, 15 basis points. And now we're actually in negative territory, essentially indicating that the market is more dovish. So there is the scope here for disappointment. So let's just first of all start off and have a look at the dot plot and see so that's what's expected. But if we actually look at the dot plot, let's just see what they said last time. And when I say last time, they only do a dot plot, of course, or a summary of economic projections every two meetings. So the last meeting, excuse me, we didn't get one. So this is actually from June the 18th. So this will be an update. So first of all, here we go. This is going to be the key thing to be looking out for. We see that the last projection in June was 3.9. And keep in mind that that's a sort of a rounded number. So what they actually do, this number is reflecting the range. Remember, the Fed likes to have a range of the Fed funds futures of 25 basis point. So it takes the range and then the midpoint, and then it rounds it up. So technically, what this is saying here is that the Fed believes that at the end of 2025, it will be between 3.75 and 4%. So 3.75 and 4%, there's the 25 basis points. 12.5 basis points would be the midpoint, which gets you to 3.875, rounded up to 3.9. Okay. So in simple terms, from where we are now at the effective Fed funds rate of 4.33, what the Fed was saying last time was two cuts. So the big question today, the big question is, will they keep it at two cuts or will they actually reduce that? So what would that look like? This number here, if they do reduce it, will go down, 25 basis points essentially, which unrounded is going to come out to about 3.6, something like that. So probably 3.6. So if it goes down there to 3.6, you know that the Fed is essentially saying the median dot is going to be for three cuts. And where does this number come from? So just to remind ourselves where this number comes from, we have the dots. So remember, this is for the end of 2025, 26, 27, and the so-called longer run, sort of the neutral rate. So what we're saying here is that at the moment, the Fed funds futures effective rate is 4.33, which is basically about here. But at the last meeting in June, where they had a summary of economic projections, the median was actually for two cuts. So the point is there were quite a few hawkish outliers. So this is all of the different members of the Fed. And what's going to be very interesting now is that this could be the most divisive or divided Federal Open Market Committee that we've had for quite some time. Because as we know, Lisa Cook was only put back into her voting position by sort of a temporary court order 24 hours ago. And also 24 hours ago, we had Stephen Miran, who of course is Trump's right-hand man, the author of the Mar-a-Lago sort of paper, or the so-called Mar-a-Lago paper. A big dove, wants lots of cuts, a Trump acolyte, basically. And now, presumably, Stephen Miran is going to vote for, I don't know, a 50 basis point cut. Who knows, maybe a 100 basis point cut. The point is that he also is entitled to put one dot. And rather than putting that at sort of two cuts, he might put it at minus 75. So it could be down here also. So it's going to be quite interesting just to see at 2 p.m. when we get the dot plot, the distribution. And I'm just curious to see if there's one kind of crazy dovish outlier down here, and we will know who that is. Obviously, that's going to be Stephen Miran. On the other hand, someone like Lisa Cook, she doesn't strike me as a vindictive or a petty person, judging by her past pronouncements, but she's been put through the ringer by the Trump administration. And I don't think she'll be voting in any kind of dovish way. Other doves on the committee, we know that Waller dissented last time. He definitely wants a 50 basis point cut. So that could be a low dot plot. We also know that Michelle Bowman, who was appointed by Trump, is more on the dovish side. So we have Bowman, Waller, and Stephen Miran, who are probably going to put pretty sort of dovish dots. On the other hand, we know that there are some slightly more conservatives, even sort of hawkish people. Who knows, maybe Cook Schmidt from the Kansas City is quite sort of conservative and hawkish. Goolsbee, actually, is Goolsbee voting. That's an interesting one. So, and of course, Powell himself, we don't know, but I think the distribution, the dispersion of dots is going to be much more substantial than this. And then, of course, we have to see what happens in 2026. So that's the dots. Now, other stuff to be looking out for. So that's the first thing. We want to see if this stays at 3.9, which I think would be a little bit of a disappointment to the market. Because remember, the market is discounting, as we saw, about 2.7 cuts. This is not 2.7 cuts by 2025. This is 2 cuts. So that would be a disappointment to the market. And then, of course, we have the 2026. So what the market is saying that between 2025, 2026, we're going to get 6 cuts in total. And really what the market will need is this to be revised down as well. So the market, again, I think will be disappointed if this doesn't go down, let's say to 3.4, something like that as well. So 2026. Also interesting will be the longer run. That's the sort of the so-called in the neutral rate where the Fed FOMC members thinks the neutral rate may be. Will that be revised upwards to indicate that the Fed is tacitly accepting a slightly higher sort of average inflation? That's going to be an interesting one. Now, in terms of other stuff, we need to look out for the summary of economic projections, which we get at 2 p.m. As I said, is just the the economic projections. So let's forget about the headline inflation, the core inflation. Now, as you can see, last time they revised that upwards from 2.8 to 3.1. No one in terms of the consensus and economists and whatnot is really expecting these numbers to change massively. But that's definitely got to be something to keep focused on. Does the Fed revise this upwards or keep it stable? Keep in mind, it's going to be very strange if the Fed begins a cutting cycle and they're revising up the core inflation. So even from a political or a consistency point of view, I would find it rather odd and incongruous if the Fed says, hey, we're going to cut today 25 basis points and maybe start a cutting cycle and maybe even cut 50 basis points and cut for 150 basis points over the next 18 months. But by the way, we personally here at the Fed believe that the core inflation is going up. And by the way, it's above our target. Remember, the target is 2%. So already, according to the Fed's internal forecast here, they have it at 3.1, 2.4, 2.1. So over the next 3 years, they have that over 2%. So there's definitely a little bit of dissonance here, a bit of cognitive dissonance happening here. And I think the Fed would be sort of quite embarrassing, even if they have to lie, to revise this upwards. So I don't expect any changes there. Now, in terms of the unemployment rate, again, at the moment, we're at about 4.3%. As you can see here, the Fed did revise it up last time from 4.4 to 4.5. Are we going to get to 4.5% by the end of 2025? Is that going to remain stable at these levels over the next few years? We'll see what the Fed has to say about that. But again, if they were to go with a 50 basis point cut today, which no one is really well, not no one, that's a low probability, maybe 5 or 10%, presumably they would revise the unemployment rate up to 4.6, 4.7, something like that, indicating a worsening sort of employment situation, a softening labor market. Now, the other thing as well is the change in GDP. They did revise that downwards last time, but it seems to me that the economy, from what I'm looking at, is doing relatively well. We had quite strong retail sales the other day. Interesting to see what they have to say. So obviously at 2 p.m. we need to be looking at the sort of forecast for where the economy is going. I would say that if they don't change the dot plot and just stay with 3.9, they're saying, hey guys, we're going to just do 2 cuts probably. We're going to be data dependent, and that's because the data hasn't changed too much, so there's not that many reasons to change. If they were to signal 3 cuts, which would be dovish, presumably some of these numbers would indicate a weakening economy and a softening labor market, and potentially even a plateauing, softening sort of inflation number. So that's going to be quite interesting. Now, the other stuff to look out for is the statement. Now, the statement, this is from last time. And again, in the first, I'll just grab some water here. In the first part of the statement, we do have a sort of a summary of the overall economy. And I expect this to change a little bit because presumably if they're starting a cutting cycle, it's the same logic that presumably, for example, for the unemployment rate, they may say remains low. Labor market conditions remain solid. I'm expecting them to tweak that a little bit. Labor market conditions have shown some signs of sort of slight weakening or deterioration. I expect there to be some change there. Inflation remains somewhat elevated. I expect them to keep that the same. On the other hand, if they were to say it remains very elevated, that would be problematic and again, a sort of a contradiction in terms if they were to cut. So I expect that to stay the same. In terms of the growth of economic activity, will they say it moderated? Interesting. I think they perhaps will do something like remain solid, because to moderate seems odd if it's moderating. Well, we'll see what they have to say, because in fact, if they continue to say it's moderating, that would also be consistent with reducing the Fed funds rate. So interesting to look at that kind of here. Again, Powell at his Jackson Hole speech did indicate that the risks to both sides of the dual mandate. He's basically saying that the risk to, if you remember his last sort of public statements, were basically saying that the risk to the employment side of the mandate had actually become a little bit more elevated. So I do believe that the committee is attentive to the risk of both sides of its dual mandate. I wonder if they're going to sort of tweak that a little bit and emphasize the fact that risks to the employment side of the mandate have slightly increased. That would also justify the cut. One thing to think about, which I think I spoke about in yesterday's video, was Stephen Miran, the new member of the FOMC, who of course is very dovish and Trump's right-hand man. He talked about this so-called third mandate of the Fed, which comes from on the Federal Reserve statutes, which no one's really looked at for a long time, which says that one of the goals of the Fed is to keep medium-term yields, bond yields, at reasonable levels, at lower and reasonable levels. And so it seems that somehow the White House, the Trump administration, Stephen Miran, are looking at this to maybe say, hey, this is part of something the Fed needs to do, is not to control not only the front end of the curve, but also the the belly of the curve. So like the 7s, the 10s, the 15s, the 20s, the 30s. Could we be getting some kind of yield curve control, some kind of sort of extra issuance of bills? And rather than sort of coupons, that's probably for another day. But that's interesting, this whole question of the mandate. And I wonder, actually, in the press conference, if I were in that press conference, I would definitely be putting my hand up, raising my arm, and saying, Mr. Chairman, what do you think about this concept of the third mandate? As now mentioned by one of your colleagues who's sitting around the table with you. Okay, obviously, if they change today and cut, they will bring the actual numbers down. But what we really need to think about is the key issue is whether Powell, and this has got to be decided whether it's going to be a dovish cut or a hawkish cut or a neutral kind of cut. Does Powell essentially say, okay, I'm cutting, we're a little bit worried about the employment situation, but we remain data dependent? Will he sort of say to the market, we are data dependent, you have one cut today, we're not going to guarantee anything else? Which of course would be sort of hawkish, and I think the market would be a little upset with that. On the other hand, will he essentially sort of say to the market, right, we are going to start some kind of cycle, maybe not 3 cuts this year, maybe just 2, but we are definitely starting on some kind of cutting cycle. And therefore, the language in this part of the statement we need to look at and say, in considering the extent and timing of additional adjustments to the target range. So this is going to be interesting. They talk about additional sort of cuts or, this kind of thing here. We really need to see basically the language there. So that's something I'll be looking out for at 2 o'clock, just to see whether the statement has changed, to give us the sense that this is indeed the beginning, or whether they're really, potentially back on pause, awaiting the data. That's going to be quite fundamental, I think, in terms of the market reaction. Some people are saying that not at this meeting, at the October meeting, their runoff of the reducing their holdings of Treasury securities. As everyone knows, they are reducing the number of bonds they hold and mortgage-backed securities, MBSs. Will they mention it at this meeting? A lot of people are saying that that's maybe going to be an October question. But if they were to do that, that would be quite dovish, in the sense that, that means that they are, they would be stopping actively reducing the size of their balance sheet, which implies, if they were to do that, that implies a little more liquidity in the system, which all things considered would be dovish for assets. So they're not expected to do that this time, but that would be interesting to see if they just continue, as I say here, to reduce the holdings of Treasury securities. If that sentence is taken out or altered, that would indicate that they're coming towards an end of the quantitative tightening, which, as I say, is extra liquidity and should be dovish. Right. Okay. So the other thing as well, of course, is just the whole question of dissenters. A lot of people are saying this could be the most sort of dispersed voting pattern we've seen for quite a long time. We know already that we had two dissenters last time. If you remember the last meeting, we had Michelle Bowman and Waller, who they actually wanted to cut last time. So it could be, will they dissent this time and say they actually want a 50 basis points cut? We also could or probably will have Stephen Miran, who presumably will vote for a 50 basis point cut. So we could have three dissenters here voting for a 50 basis point cut. Will there actually also be some dissenters, maybe Schmid of the Kansas City Fed, who actually decides to hold? Because there have been, quite a few sort of committee members, people like Goolsbee, Schmidt, who have said, well, we're not exactly convinced that inflation is completely defeated and we have some problems. We don't really see the need to cut at this point. So we could have a situation where we get a 25 basis point cut, dissenters wanting 50 basis point, some people even going for a hold. So there could be a dispersion here. So this is going to be quite an interesting paragraph as well. And of course, in terms of the market reaction, the nature and the quantity, the magnitude of the dissensions will also determine a little bit the market reaction. Obviously, if there's many dissenters with 50 basis points, the market might like that in the sense of finding that more dovish. On the other hand, if there's only, let's say, Miran is the only dissenter, and in fact, one or two dissenters who wanted to just hold and not cut at all, that of course would be taken as quite hawkish. So that's the situation here. Just wanted to have a look. Just wanted to show you something here. The other thing which is kind of interesting is, in terms of market reaction, is just look at the curve here this is across the whole curve. And as you can see at the front of the curve, this is literally bills. Okay, so almost like money market notes. So you see 1 month, 2 months, 3 months, very short term. And you can see that these guys are currently trading, around about 4%, just under 4%. So really, in terms of value on the curve, the market, as I say, it's fully priced in, fully discounted for one cut, potential for 50 basis points. We want to know what's happening in 2025. We want to know potentially how deep these cuts will go. Is that sort of a terminal rate of 150 basis points of cuts, realistic, adequate, not enough? Some market commentators are saying the economy is going to fall off a cliff and they'll end up having to cut maybe 200 basis points, not 150. But the point is here, just in terms of immediate market reaction, just keep in mind at the very front of the curve here, in terms of the short-term money market bills and whatnot. Look at the carry here. You're actually getting paid more yield than the twos, threes, fours, fives, sixes. So the point is here that the carry only becomes kind of interesting, really, compared to the money market instruments or cash or bills, let's call it bills, once you get out to the belly of the curve in the 10-year. So you see the 10-year, is paying, where are we? We're at about, what's that, about 4% or so, obviously. But you see that anything down here, a lot of the dovish repricing and Fed cuts has already been sort of priced in a certain sense. So this does not represent great value. My point being that in order to get the belly of the curve to move substantially today, I think it would have to be considered as sort of a dovish cut. So what does a dovish cut look like? Obviously, if they cut 50 basis points, that would consider dovish. We would need to see a dovish cut. We would need to see, if we don't get a 50 basis points cut, we would need to see the dot plot definitely moving down to 3.6 for 25 and probably down 25 or even 50 basis points for 2026. We would have to see the statement indicating a slowdown in the economy, So maybe GDP numbers revised downwards, maybe inflation flat or even revised downwards, and then unemployment levels going up. So basically a solid justification for cuts or further more extensive cuts. And that way, the very front of the curve could maybe come down in yield here, and maybe even, some of these like 5s, 6s, 7s could even come down a little bit. So, this kind of part of the curve could come down in yield, and the very, very, very short front end of the yield curve could come down as well. That would represent more value. So if we don't get, though, and what would disappoint the market, what would be a sort of a hawkish cut would be essentially if the dot plot doesn't change, so it stays at 3.9, so just two cuts, and whether the sort of summary of economic conditions, maybe let's say, for example, the the GDP numbers revised upwards by a tenth or two tenths. Let's say unemployment rate number remains unchanged. Let's say inflation number remains unchanged. And of course, the communication in the statement is not indicating an economy which is really in troubles. And if the statement and then at the press conference, if Powell essentially says, no, I'm data dependent, we wanted to do a bit of an insurance cut. We have seen some small signs of labor market weakness, but actually things are relatively robust, relatively solid. There's still a tariff uncertainty. There's still sticky inflation. We're going to be data dependent, et cetera, et cetera, et cetera. If Powell equivocates, like not only in the statement but especially verbally in the press conference, I think there is room for disappointment there, because the market, as I say, has fairly substantially repriced, and we can see that if we look here. Let's say, for example, looking out for the uh, oh, that's interesting. The Bloomberg here has just taken off today's. Uh, it's taken off the, I guess it's assuming today is already sort of past history. That's interesting. But if we look here out at the December pricing here, I'll put that on, I don't know, what should we do? We'll do a 15-minute chart. Let's go back. Actually, I want to go back, let's say 2 months. So that would be 60 days. How do I get to 60 days? Can I do 60 days? There we go. Why don't we go out to, oh no, we'll do 30 days. That's fine. So I just want to go out to 30 days. So let's say the last month. And the point I'm trying to say here, if you look here, this is the amount of cuts. So this is two cuts here, 50 basis points. You see negative 50. So if we go back to something like the 21st of August, which is here, you can see that essentially since then the market has become more and more and more dovish. Then we had the August jobs revisions, boom and down. So at this point, the market has priced in more dovishly these expectations. So there is room for disappointment. And where could the disappointment be? The disappointment could be that if we let's start looking at some of the markets. So you look at the equities here. This is not really a gap. This is just the contract roll higher. If you look at the equities market here, you can see they're at highs. You can see Nasdaq also at highs. And really some of this, stuff, obviously AI boom, et cetera, but a lot of this is predicated on the fact that, the real economy is doing relatively well. The Fed is going to embark on a nice juicy cutting cycle. So essentially this idea that the Fed is cutting into a robust economy. That's very different and is essentially in front of the curve. That is a different scenario than the Fed being behind the curve. What would be interesting today in terms of the stocks as well is if, the statement and Powell and the dot plots and the summary of economic projections all gave this idea that there was sort of something to panic about or to worry about, that the economy really was going to be slowing down in terms of the Fed, in terms of the Fed's judgments. And at that point, suddenly, we're not cutting into a robust economy, but we're cutting by necessity into a weakening economy. And one could argue that that would be a less attractive environment for stocks, which are at fairly elevated valuations here, like you see the Nasdaq and the ES. So that's going to be interesting for those guys. And if you look at something like the Russell, you can see not quite at highs, but it's also had a very nice run up since Liberation Day, early April here. The Russell, as we know, a lot of those companies have floating rates. I was reading some research. I think I was talked about it yesterday. 50–60% of the companies in the Russell work on floating rates for their financing, which is tied to the SOFR, the very short-term rates, which is controlled by the Fed. So if the Fed, is to cut today and it indicates a pretty aggressive cutting cycle, that could be positive for the companies in the Russells, the small caps. But on the other hand, it's got to be this delicate balancing act. Are they cutting because they think the economy is slowing, or are they just doing a few little tweak cuts, subtle cuts just to keep things, to turn the ship a little bit. And that would be quite positive. Other markets to look at here, if we look at sort of bond markets, as I say, if we look at, well, actually, let's look at the yields. It's probably going to be easier. Or actually, just before we do that, we'll look at the dollar, because I've got it here. So obviously the dollar's been weakening. Again, this has been a lot, Fed independence, assets leaving the US, bond yields going down, inflation, fiat debasement, et cetera, lack of, fiscal discipline, a lot of things. If the Fed, again, today, this is probably, it's fully discounted the cut, as we all know. So that really, can the dollar break this key level at about 96 and a half? Can it break it? That's really going to be, it's going to depend on whether it's a hawkish cut or a dovish cut. And if it is a hawkish cut, the market is fairly stretched to the downside. So there could definitely be here, a little bit of a short covering relief rally. I don't know how substantial it would be, maybe several days. I don't know if that would last a long time because the market is very stretchy. On the other hand, if it's dovish and, the economy is falling off a cliff and et cetera, for sure, the dollar index and it can fall below here. And obviously that would lead to, let's say, something like the euro breaking these highs up here, which it already has done, and maybe heading up to 120. And then we can see everything else here. We can see the yen breaking. Look at the yen here, getting starting to get below the fib levels, the 50% level here, the 61.8 fib retracement. We've got a bunch of levels here at around about 146.3. For sure, that could break down, and then we could be heading all the way back down to 142 or so. So definitely, that's going to be affected today. In terms of the bonds, we can look at, I've been showing you some of the differentials here, let's say between the US 2-year and the German 2-year. You can see that those differentials have tightened a lot. Now, again, is this all fully discounted? The Fed is cutting. Again, it's going to be interesting. If we have a dovish sort of communication today, and obviously a 50 basis point cut, that can definitely get down a little bit further, down to 1.38 here. On the other hand, if Powell's very sort of data dependent and sort of, circumspect about the future path of rate cuts, maybe this is going to start sort of flattening out here a little bit, which potentially could be a negative or a headwind for the euro versus the USD. So it's interesting to keep an eye on these differentials between the US and, for example, the German bonds. In terms of the yield curve in the US, we know that, as I said, there's a lot of the SOFR products, the SOFR instruments at the very front end of the curve have dovishly repriced over the last, 4 to 6 weeks or so. But we can also see the same things happening with the 2-year yield. Look at the 2-year. So obviously that's come down from, around about 4%. We had those job numbers revisions on the 1st of August from non-farm payrolls. That's come down from basically 4% to where we're trading currently at 3.5%. So that's come down 50 basis points in, not a long time, in 6 weeks. So that is a substantial, that is the equivalent of 2 cuts, 2 extra cuts being priced in. So my point being here that the market needs to hear something fairly dovish in terms of these instruments like the short-term bonds to further fall in yield or to rally in price. And as you can see, there is getting to be a little bit of support here on the downside. Anything less than quite serious dovishness, I think also we could see a little bit of a run up in the yields. Maybe not long term, but a run up over the next 36 hours in the front end of the curve. In terms of the back end of the curve, that's also pretty interesting because one of the logics for the steepener trade was, lack of fiscal discipline, plenty of bond issuance, inflation is still sticky, et cetera, et cetera. And they're all good reasons. But as you can see here, the 30-year yield also has come down from, let's say, 5% to about 4.63%. So not quite as much as the front end, but the 30-year, excuse me, I do beg your pardon. The 30-year yield has also come down about 45 basis points or so. So that seems to be signifying either less inflation expectations or less inflation expectations because of a slowing economy, a worsening unemployment rate, the expectation that the Fed would cut, potentially even some kind of yield curve control, the notorious third mandate being talked about by Stephen Miran. So interesting to see as well. If we do get, I think really where we go now, this is getting to a point where this has come quite a long way. You see it's at quite an interesting technical level. Can this come down further? I think really it's going to be about the projections and whether Powell sort of gives a sense that, the economy is falling off a cliff, therefore inflation will probably come down. The tariff impact doesn't seem to be that serious. Et cetera, et cetera, et cetera. So it's going to be an interesting one to watch, and of course that will affect the shape of the curve. If we get sort of dovishness today, but Powell says the economy is pretty strong, I think we could start to see a re-steepening of the curve. Because it does make sense that if we look at something like the 230s, this is the yield curve. As you can see, it has flattened quite a lot. It's at a very interesting sort of top of the range point here. So that this is a nice level for it to re-steepen. So that's definitely something to be looking out for today. And as I say, it would re-steepen, if the Fed is relatively dovish in terms of the future path of rate cuts. But on the other hand, they say the economy is relatively strong and the summary of economic projections, they're not too sort of pessimistic. And the market might say, well, hold on, you're cutting into a fairly strong economy and inflation's still happening. And we'll get that old narrative, which has caused all of this steepening. And we may actually just view this as a bit of a temporary retrace and it might start pushing up again. Um, Other markets here, gold, as we all see, I mean, there's all kinds of structural reasons to be long gold. We know central bank buying is massive by the Chinese, especially. We know that retail is pouring money into gold. There's sort of a fiat currency debasement. Inflation does seem to be a bit sticky still in the US, and geopolitical uncertainty, et cetera, et cetera, and potentially even an economic slowdown. So plenty of good structural reasons to be long gold, but obviously, this has been going up for a long, long time. If we have a slightly disappointed market today, a slightly hawkish cut, can this test back down to, 3,600, 3,650? Yeah, I think that's absolutely possible. Maybe not a huge short, but, definitely a sort of tactical short is a possibility. Okay, guys, I'll leave it there. I've already spoken too long. As I say, 2 o'clock Eastern is when that's all happening. And then obviously we have Powell's press conference at 2:30. We do have the Bank of Canada this morning. They are expected to cut by 25 basis points. I mean, that's a whole other conversation. The Canadian dollar will be determined by that, but of course, what happens with the Fed this afternoon. So we have to look at that as an ensemble of factors there. It will be interesting to see what the Governor Macklin says about the Canadian economy. Is he sort of, a bit upbeat? Is he neutral? Or does he acknowledge the fact that unemployment in Canada is now up to 7%, which is the worst it's been for quite a long time, and that further cuts are coming? So that's coming this morning, the Bank of Canada. Let's keep an eye out for that. And of course, put it all together with the Fed later on this afternoon. Thanks very much. Hope that was useful, and we will continue this tomorrow. Thank you.